For years, investors were told that private credit was the smartest corner of modern finance. While banks struggled under regulation and public markets swung violently, private credit promised something rare: high returns without volatility. It was described as safer than stocks, more profitable than bonds, and insulated from market panic. Pension funds, insurance companies, sovereign wealth funds, and wealthy individuals all bought into the same story. But what if that story is now breaking? What if the safest looking market in finance is becoming the most dangerous one, slowly, silently, and largely out of sight? Because right now, the private credit market is under pressure in ways most investors never expected. Losses are growing, defaults are rising, valuations are being adjusted behind closed doors, and some of the biggest funds in the world are discovering a painful truth. Private credit doesn't avoid risk at heights, and hidden risk has a habit of surfacing all at once. To understand why this matters, we need to step back. Because private credit didn't start as a problem. It started as a solution, and like many financial solutions before it, success planted the seeds of its own stress. Private credit, at its core, is simple. Instead of borrowing from banks or issuing bonds in public markets, companies borrow directly from private funds. These loans are negotiated privately, held on balance sheets, and rarely traded. For investors, this promised stable income and protection from daily market swings. For companies, it meant faster access to capital and fewer regulatory hurdles. The modern private credit market began its rapid rise after the global financial crisis of 2008, when banks nearly collapsed. Governments responded with strict regulations. Capital requirements increased. Risk-taking was restricted. Lending standards tightened. From a stability standpoint, this made sense, but it created a gap. Companies still needed credit, especially mid-sized firms that were too risky for banks but too small for bond markets. Into that gap stepped private credit funds. At first, this shift looked healthy. Credit was moving from fragile banks to long-term investors. Risk was supposedly being matched with patient capital. Returns were strong, defaults were low, and the system appeared stable. This success attracted more money, and more money changed everything. As inflows accelerated, competition into funds needed deals. To win those deals, they accepted weaker protections. Covenants were loosened. Leverage increased. Borrowers took on more debt with fewer restrictions. But because interest rates were low and growth was steady, problems stayed hidden. This is where cause and effect begins to matter. Low interest rates made debt look harmless. Weak companies could refinance instead of failing. Losses could be delayed instead of recognized. Valuations could be smoothed instead of marked to market. And because private credit assets were not traded publicly, there was no daily price to challenge the narrative. This created the illusion of stability. As years passed, private credit grew from a niche strategy into a core pillar of global finance. Trillions of dollars flowed in. Funds grew massive. And with size came concentration. The same borrowers appeared across multiple funds. The same risks were repeated again and again. But no one saw the full picture. Then the environment changed. Inflation surged. Central banks raised interest rates aggressively. For the first time in years, debt became expensive. And suddenly the math that supported private credit began to break down. Higher rates increased interest payments for borrowers. Higher payments reduced cash flow. Reduced cash flow made refinancing harder. And harder refinancing exposed which companies were surviving only because money had been cheap. This is the breaking point, Faizan. It never arrives quietly. Defaults in private credit don't explode overnight. They rise gradually. A missed payment here, a restructuring there. Funds extend maturities. They renegotiate terms. They delay recognition. This keeps reported losses low, but pressure builds beneath the surface. Now, big funds are facing a dilemma. Admit losses and risk investor panic or delay and risk something worse later. Many choose delay. Valuations are adjusted slowly. Losses are spread over time. Assets are marked based on models, not market prices. But investors are starting to notice something else. Liquidity is disappearing. Redemptions are delayed. Withdrawals are limited. Capital is trapped. This is where private credit structure becomes its weakness. Funds promise liquidity while investing in illiquid assets. That works when confidence is high and redemptions are low. But when stress rises, exits disappear. And once investors realize they can't easily get out, confidence erodes. This is how localized pressure becomes systemic risk. The fallout from a stressed private credit market doesn't stay inside private funds. Pension funds depend on these returns. Insurance companies rely on this income. Banks lend to these funds and provide leverage. When losses grow, the shock spreads outward. We've seen this pattern before. In past crises, risk always accumulated in places considered safe. Subprime mortgages were once described as stable. R-rated securities were considered untouchable. Structured products promised diversification. Each time, complexity hid fragility. And each chimney, when conditions changed, losses appeared suddenly. Private credit today shares those characteristics. Limited transparency, model-based valuations, leverage dependence on refinancing, and heavy exposure to economic cycles. What makes this moment especially dangerous is scale. The private credit market is larger than ever. Its connections to the real economy are deeper, and its exposure to rising rates is unprecedented. The usual fixes are weaker too. Central banks face inflation constraints. Governments are hesitant to rescue private investors, and private markets lack the transparency needed for quick intervention. This means losses must be absorbed somewhere. Now let's connect this story to modern parallels. Across the economy, stress is rising. Corporate defaults are increasing. Commercial real estate is under pressure. Leveraged loans are weakening. These risks overlap heavily with private credit portfolios. The same borrowers appear again and again across different strategies. History tells us that when multiple stress points align, outcomes accelerate. So where does this leave us? The private credit market is not collapsing, but it is cracking, and cracks spread under pressure. The longer losses remain hidden, the more painful their eventual recognition becomes. This brings us to the final lessons. The first takeaway is that private does not mean safe. It often means opaque. The second takeaway is that delayed losses are not avoided losses. They are stored losses. And the third takeaway is that liquidity matters most when you need it most. The warning is clear, but the next financial shock may not start with a crash. It may start quietly inside private credit funds as losses accumulate out of sight. But when those losses surface, they won't stay contained. If you want to understand what's really happening beneath the surface of global finance before it reaches the headlines, stay with us. Subscribe, like, and share this video. Because the most important financial stories are often the ones unfolding quietly, long before the world is paying attention.